Welcome, and thank you for joining us. I'm David Parks, and along with Francesca Dominici, I'm the faculty co-director of the Harvard Data Science Initiative. Today's event on networks and markets is one of several panel discussions that we have hosted over the past year to celebrate the Harvard Data Science Initiative's anniversary. I'm delighted this afternoon to introduce our moderator, computer scientist, entrepreneur, and former CEO and former CFO of Goldman Sachs, Marty Chavez. Today, Marty is partner and vice chairman of Sixth Street Partners. Marty's connections with Harvard are deep. He arrived from Albuquerque to Harvard College in the fall of 1981, to be followed in future years by his four younger siblings, all of whom attended Harvard. He graduated with an AB in biochemical sciences and an SM in computer science. The latter thanks in part, I think, to my colleague, Harry Lewis. Later, he would gain a PhD in medical information sciences from Stanford. But he never really left the Harvard orbit, and in recent years served on Harvard's Board of Overseers, including as its president during the 2020-21 academic year. A disruptor at heart, from his time at Goldman, Marty has firsthand experience on how software has transformed the financial industry, or how software aid finance in the parlance of his GSB course at Stanford. So I could think of nobody better suited to lead this panel on networks and markets, and I'm delighted he's here. During this event, Marty will lead our fantastic group of panelists from Harvard Business School and the University of Surrey in conversation over technology platforms, data sharing, governance, and whether, and if so, how should we regulate? What parallels can be drawn from the regulations of finance? What happens as finance becomes software? So Marty, thank you for being here today and for directing what we know will be an informative and thought-provoking discussion. Over to you. Please take it away.
David, thank you for that extremely gracious introduction. Just one clarification. I was Chief Information Officer and later Chief Financial Officer.
I noticed that right as I said it, Marty.
Goldman Sachs, so thank goodness, not CEO.
Thank you for correcting on the records.
And it is a delight to be here. I am doing all kinds of things, but I'm mostly a computer scientist, and I've certainly had occasion to have spirited dialogue, conversation, argument, disputation with many of my friends in Wall Street and Silicon Valley about the kinds of regulation that do and don't work. Definitely experienced during 25 years on Wall Street regulation, and at the end of all of it, I would say that the greatest testament to the efficacy of regulation was the performance of banks during the pandemic. Of all of the sectors that had troubles, you heard very little about stress in the banking sector, when ordinarily it would have been the canary in the coal mine, the first thing to experience duress. There were difficulties. Not a lot of them rose to the public dialogue, but certainly behind the scenes and the plumbing of the financial system, there are all kinds of intense moments. But there were not intense moments because the banks had perhaps too little capital or liquidity. There were other kinds of operational problems in the system, which I think points out that risk simply transmutes into different forms. It's not, to my knowledge, really ever been the case that risk simply disappears. And so it was with that in mind, as seeing what did and didn't work in the banking regulation, that many have opined, pontificated on what might work for regulating big tech. And I would look at analogies from the banking regulation, where I would say, personal opinion, many of the rules amounted to red tape, but some of the rules absolutely were transformational in making the system safer and sounder. And so I'd want us to look for those kinds of rules when we think not just about social media, which is much in the news, but anything digital markets, digital economies, digital assets, digital payments, anything that's digitized. Because I think we can all agree, one of the few safe predictions is that more and more things will be digitized and dematerialized in the future than in the past. There's very few trends I'll forecast, but I'll stand by that one. So with that bit of an introduction, I'm going to go around the panel, and I'm going to very briefly introduce each of you, and then I'll ask you to introduce yourselves, and then say whatever inspires you to frame our discussion today. And then after that, we'll go back and forth. And I really encourage people to say exactly what's on their minds. I'm sure everybody will be polite, but let's also be direct. And so I'll start. We have two Marcos, so I'm going to have to use full names. Marco Di Maggio from Harvard Business School. Would you please introduce yourself and make some intro remarks?
Very nice being here. Thank you so much for having me, and it's a pleasure to participate in this panel. I'm a professor of finance at Harvard Business School, and I mainly research how new technologies affect financial markets and the provision of financial services. This spans from the use of algorithmic trading to the use of alternative data in credit underwriting, up to the more recent innovations in blockchain. In particular, how decentralized finance is innovating different type of financial services. And so I think this is very much topical because of the need as well as the push towards the introduction of a new regulatory framework for DeFi. So I look forward to sort of share a few thoughts about that.
Thank you, Marco. And then Marco Iansiti, over to you, also from Harvard Business School.
Thank you, Marty. It's such a pleasure to be here, and it's such an incredible topic right now. I really do think this is potentially the most important topic that we have in front of us, because it's such a meta driver of many crucial decisions that are causing all kinds of challenges for us going forward. So delighted to be here. 30 years at Harvard Business School, kind of a long time. It kind of, to really date me, you can say like the very first thing I did at Harvard Business School was actually write a case study on a tiny little company that had just gone public. It was called Microsoft. So that's been around doing this stuff for a little while. Spent 10 years running our technology and operations management group. And interestingly, going through our own transformation in some ways and really building out a whole new set of capabilities around how we teach and how we do research around how companies are managed, how companies are built, and I think relevant to this discussion in a number of different ways. My interests are very much around digital transformation, both of companies and on the economy. And I've written a couple of books on this, and I'll refer to these as we go through the various remarks. One more important thing, a big disclaimer in this one. I am super conflicted on everything, so you really shouldn't believe anything I say at all, because I've worked with pretty much every single one of the companies in dispute, and I've also worked with pretty much every single one of the organizations that are challenging some of these companies, including the European Competition Authority and the U.S. Department of Justice and so on. So basically, apart from not believing anything that I say, everything else is game. So thank you, Marty.
Well, Marco, maybe if you're arming all sides, then that mitigates your conflict. I don't know.
It's possible. It's possible. Yeah, one would think, maybe.
That's exciting. That's a great connectivity to have with all the stakeholders. So look forward to hearing more. Chiara, would you please introduce yourself? Chiara Farronato from Harvard Business School.
Thank you, Martin, for organizing this panel. Thank you, David, as well, for having us. I'm excited to be here. I'm also faculty at Harvard Business School in the Technology and Operations Management unit that Marco Iansiti talked about. Actually, in fact, he was the unit head when I was hired in that unit. So I like to think I'm part of that transformation as well. I am an economist, and I study the growth of digital platforms. And some of the challenges that these growth may create for agents in the economy. So think about challenges that this growth and their dominance may create for consumers, for service providers, and for incumbents. I've studied, for example, the entry of Airbnb in the accommodations market, highlighting some of the values, but some of the costs that that entry has created in that market. Because some of these challenges pose some significant policy issues, I'm really excited to participate in this panel because a lot of my research really focuses on the trade-off of different policy alternatives. And what I think is important is that even managers at these companies really, there's value in them being able to anticipate and assessing these challenges so that they can understand when to expect strong calls for regulation, which seems to be the case right now, and when individual private incentives may be enough. So thank you for having me.
Thank you, Chiara. And Annabelle Gawer from the University of Surrey, would you please introduce yourself?
Yes, thanks, Marty. Delighted to be here. My affiliation with Harvard is thanks to my co-author, David Yaffe, who is a professor at Harvard Business School. Together with him and Michael Cusumano, who's professor at MIT, we co-authored a book called The Business of Platforms. It's about strategy in the age of digital competition, innovation, and power. And actually, Harvard Business School runs an executive education program called Competing in the Age of Digital Platforms, which is based on our book. I'm the director of the Center of Digital Economy at the University of Surrey, which is in the UK, where I'm a professor in digital economy. And I've worked on the topic of platforms since really the mid-1990s. So my first book was with Michael Cusumano was called Platform Leadership, and that was based on my PhD thesis. And at the time, it was a time before Amazon and Google and Facebook. It was looking at Microsoft, Intel, Cisco, and others. And we looked at how platforms can be used to stimulate innovation by third parties on complement. So we really looked at innovation ecosystems. So I've been working in this area for over 20 years. And in the past 3 to 4 years, I've been asked to play the role of an expert at the European Commission in their new observatory of the online platform economy. Some of that work influenced the development of the Digital Markets Act and the Digital Services Act. I've written a report also for the European Parliament on online platforms, economic and societal effects. So from the role of, so I continue to be a business school professor, but because of my interest and expertise in the topic, I've been able to see a little bit what's happening on the side of regulators.
Well, thank you, Annabelle. We have an incredible group of people here. It's hard to know where to start. As I was listening to Annabelle, I was thinking about Jaron Lanier. I'm sure you've read some of his books, and he wrote "Who Owns the Future?" maybe 10 years ago, and he talked about siren servers then, and he was a little bit ahead of his time, I think. But now we've come to see what out of curiosity, what do you think of his thesis and his recommendations and what's changed in 10 years?
Jaron Lanier. I actually think he's very much a visionary. So he thinks in particular of social media platform as, I think he calls them empires of manipulation, or I mean, he really thinks of them as only defined by the way they manipulate their users by giving them dopamine hit when they click on likes, and that the whole nature of what these companies do is to manipulate individuals. So he has a very profound critique of social media platforms that goes way beyond antitrust and making sure digital markets remain contestable. He really worries about what it does to humans. And I think he joins the work of another Harvard a professor, Shoshana Zuboff, who's very worried about what she calls surveillance capitalism. So I think their critique is worth paying attention to, and it goes a lot deeper than when we talk about when we usually talk about the regulation of digital platforms today.
And so just to put you on the spot a little bit, what would you think? Also, Shoshana's work affected me profoundly, and I'm always thinking of ways to say in more pedestrian language what she has said so brilliantly. I'm curious what you think about her critique and what you would take from it in your recommendations.
So I think the concerns of a pervasive surveillance are well founded. I think sometimes she's really she's going very far in her critique, and I understand that it's very helpful to raise alarm, but I tend to try to find a middle way where the interests of private enterprises can be combined with the social welfare. And I think that there comes a point where demonizing the biggest platform today might not lead to the best possible result. First of all, because they're here to stay. Second, because even if these particular companies might not continue on the same trajectory of growth that they have, what will replace them will still have the form of a digital platform within an ecosystem, because I very much believe that the platform within an ecosystem is going to become the dominant organizational form of the digital economy, and that whatever name there will be on owning the company, that way of creating value and that way to organize is here to stay. So I'm trying to dissociate what is here to stay and that is part and parcel of the way to create value in a digital connected economy, and some particular forms of abuse of power which have been documented and I think can be addressed by both regulation and self-regulation. So I think that the only reservation I would have, if you wish, with some of what's been written by Shoshana and some of her followers, would be careful about demonizing and polarizing what the situation where what we need is lucidity, but also nuance.
So Annabelle, I'm going to come back to you, especially on this topic. The platform will always be central, because there's certainly people who say, well, the new form will be a DAO, and maybe that's just a platform too. So we'll please hold that thought, and we will come back to it. But certainly, I share your perspective in that I think since the beginning of capitalism, if you think of companies as maximizing profit, that's what they do. And so perhaps it's just a frame of mind that I grew up with, or maybe I got it at Harvard. If you want something other than that, then you have to modify the profit function. And there's a few ways to do that. With banks, you can require them to have more capital, which reduces their return on equity. And with others, you can tax them, which has its own complications. But I too like to stay neutral and leave the moral and ethical categories for people who have that philosophical skill set, and I'll stick to my financial and software skill set. But Marco, I'm going to put you on the spot now and ask you, as we and Jaron and Shoshana and others everywhere are talking about social media and society's ills and linking the two. Can we blame social media for these ills, or is it a symptom of a deeper cause? Absolutely.
I think we can blame them for sure. And I think, but even more broadly, I think something really profound has happened in the economy, which is, for the first time in a long, long period of time, we are building organizations differently. We're building firms differently, right? So we've had, the history of business, right, for many, many, many years, we've had certain types of rules in the design of companies that have been around for a long time. And so, really from the 1600s, people had built companies around people, workers, managers, with all kinds of technology that was in there to actually help the people and the manager do their work better. And sometimes that technology progressed and you have things like assembly lines and automation, but fundamentally still companies are run by managers and decisions are made by people. I think what we've seen in the last couple of decades is really the emergence of a fundamentally different model in which companies are built, right? So if you think about a bad decision at Facebook or a poor pricing decision at Amazon, right? Who is really making that decision? Well, the critical path, right? In my unit, we always love to talk about the bottleneck in operations, right? So what actually drives your ability to do things when you're operating the company? Traditionally, it's been managers and people. There's a new set of organizations right now that is built around software and algorithms and making those decisions. That is a profound change because it really fundamentally restructures the way that operating models work. Operating models are the way the companies run, the guts of the organization, how companies do things, right? Traditionally, you had a bunch of people running around making decisions and doing stuff, operating equipment, if you like, but also fundamentally being in control of what happens. The new model of how you build a company is fundamentally about it's a combination of software and data that drives a bunch of different traditional processes, automates a lot of things, generates predictions. And you have a bunch of people that kind of design this, ideally monitor this, at least the extent that they can, right? But they're not in there making every decision or making even just managing the bulk of these decisions. They're really outside of the process. They're outside of the operating model, even in some ways. So that has huge implications. It changes three fundamental things. Because companies traditionally have been about doing three things. Number one is taking something that an individual can do and scaling it up, right? The assembly line, the big industrial revolution was all about scale. And we've seen more and more innovation around process to enable scale, but digital technologies fundamentally reshaped the way that scaling is done. There's no cost to scale. I mean, yeah, there's a little bit of, you get your cloud bill from Amazon or Microsoft or whoever, but fundamentally there is no managerial cost to scale, and there is no constraint on scale. Secondly, the second dimension around which we built organizations is scope. So how broadly can an organization do things, right? And that's scale and scope. Traditional people like Al Chandler talked a lot about scale and scope and how those are the two fundamental things that companies are really built to do. And again, scope, if you have a digital operating core, it's trivial because you have interfaces, you have APIs, right? And so you can have an organization, like favorite example of someone like Gain Financial that starts off doing payment, and all of a sudden now you append to that, thousands of other services. And again, no marginal cost. So the power of what these things can do is enormous. The third piece that goes a little beyond Chandler is the fact that beyond scale and scope, you also have, there's a dimension of learning or adjustment or flexibility or, God forbid, personalization. Basically, when you have software and algorithms driving how you serve a customer, what ad flashes up in front of you when you check your Instagram, you can personalize that, and you can personalize that at zero marginal cost. Like there's absolutely no cost to having a tailored message that fits you in the best possible way. Now, this combination of infinite scale, infinite scope, and zero cost personalization creates a huge set of issues that I think is fundamental to many of the challenges that we have. So why do we have so much problems with privacy right now? Why do we have problems with bias at a scale that we've never seen before? Why do we have problems with disinformation in a way that is changing so many of the fundamental debates that we have? There's always been disinformation, but not at this scale, and not with this level of tailored personalization, nor across so many different aspects of life. And so that's where, social media, yes, but watch out, because every organization that deploys a digital operating model can do the same things. So they can drive along these three dimensions. And traditional firms, your old buddies at Goldman, and even, you have some good stories yourself of driving as much digital transformation as you can along this, because the operating model that advantages are huge in so many different dimensions. And yet the challenges also come along with it.
So Marco, as I'm listening, and then you reminded me of Goldman, and of course, one of the things that I worked on was the automation of trading, electronic trading.
Right.
Of course, many people worked on that, but that was a really vivid example of the transformation you described, where when I arrived at Goldman in '93, we had many groups of people, but I'll call out two of them in the trading business. We had quants or strats, data scientists like me, and then we had traders. There were way more traders than quants. There were hundreds and hundreds of traders and 10 quants. And we had a very strict division between the two. We said quants write the software, including the models that mark all of our derivatives or positions to market. And traders must never touch those models or any software, because traders could influence the marks. And of course, there was obvious conflicts. Then on the flip side, we said, and strats, data scientists, strategists, to mitigate their potential conflicts, must never commit capital, must never buy or sell anything. That was the very strict division. And we stuck to it for a long time. And then we realized that the software was making all the buying and selling decisions. And the trader who owned the trading book didn't necessarily know what the software was doing. And so it became less and less consistent with reality to say that the traders were committing capital and the quants were committing software. And then we ended up, and this was a complex construct, working out with the regulators and our own partners, was traders who code, right? So they had all the regulatory requirements of traders who commit capital, and they also wrote software. And since everything is being digitized and everything is becoming software, we concerned ourselves with the different kinds of software that different people could modify, right? As opposed to saying traders shall never touch software and strats have a monopoly on the software. Well, that wasn't gonna work anymore. I wonder, just as I'm saying this, does any of that resonate with the kinds of changes that we might want to make far away from Wall Street, as more and more of the decisions that used to be made by people are made by software?
No, I think absolutely, because, and you can see it, right? That what would have happened? Goldman is an organization of strong values and all kinds of things, but yeah, what would have happened to the financial services as a sector if the digital transformation of financial services had happened without regulation, right? And some probably would have gotten it right, but would some have gotten it wrong, or would someone have gotten everything right, or some things wrong? I think it's important to have checks and balances in this. And at the same time, the complexity of financial services regulation is also really interesting, right? It's not just a few relatively static rules. You have organizations whose sole purpose is to do this, that bankers, I'm sure, complain about constantly. But there, as part of this, the more dynamic these organizations are in doing the things that they do, I think the more dynamic we need to think, the more about in terms of regulation processes and approaches. And so I think that the issue, in my view, is what can we learn from a lot of that, and how do we think about this in a way that manages this new range of organizations that we fundamentally don't understand as a society, and that is already causing substantial challenges, not to be done anytime soon, I don't think. And first order issues, problems of, vaccine information, or, preserving democracy, or, whatever, sustainability, ground truth, and things like that. So if all of these things go out the window, it's not clear what we're left with. And so this is where I think regulation needs to be done in a very dynamic and thought through fashion.
Well, the leading example I would give there on regulation that was thoughtful and intense is the Federal Reserve's capital adequacy regime, which picks up from the fact that banks for a long time had been simulating their business to assess the riskiness of their business. And so some people at the Fed, really specifically the vice chairman of supervision at the time, Mr. Tarullo, thought, well, let's use that elaborate mathematical and analytic and software framework, and then we'll give the banks a scenario that's adverse, and then we'll ask them to simulate themselves in that scenario and prove to us that they have enough capital and liquidity to continue performing their functions. And so it's all came out of one line in the Dodd-Frank statute, right? And then the Fed worked with the banks, and I and thousands of people were a part of that, to upgrade these simulation frameworks and make it a part of the regulation. So that's an example of where you can couple these complex worlds.
And it's a good one, right? It really goes back to what Annabelle was saying, in that it's not about, taking pot shots at quote unquote villains or whatever it is. It's really about working with them to try to figure out how you sort of harness, if you like, the downside of these incredibly complex platform style organizations.
There's also ways to get it wrong. And I have to tell this short story for David and a nod to Harry Lewis. This actually happened, David. I went to a European capital and met with the regulator, and the regulator had an idea, which was to cause us to write documents about our algos and then submit the documents to them, and then they would review the documents for the correctness of their algos. And I thought, oh my goodness, this is the halting problem. And so I went to this European capital, and well, now I'll give it away. And I said, well, one of your countrymen about 100 years ago revolutionized the way of our thinking by proving that what you want is impossible. And the regulator said, well, that's a rather dark view. And I said, it's not a dark view, it's a theorem.
It's science.
and so the conversation went from there. But it was interesting. I finally realized, wow, all this stuff I learned in CS 121 a million years ago is actually relevant. Like, that would not be the way to regulate algos. And indeed, we came up with many other ways to regulate electronic trading algos that took their inspiration more from how railroads were regulated, right? So you put a lot of effort into regulating at the boundaries, at the intersections, at the places where a train can change tracks, right? And as opposed to regulating every aspect of building a train and every aspect of its motion. And that seems to have worked. But Chiara, let me turn to you. So Marco, I want to be careful about paraphrasing what you said, but I asked you if we can blame social media for society's ills, and you said yes. And then you explained what is going on and how these companies are different, and decisions that were made by people are now made by software. But Chiara, I'm going to ask you if this is the case, if social media is to blame, let's use that word gently, right? There's something in the way they're operating that's not working the way we want it to work. What are those features of social media? And what are the root causes? And can we say that the algos are to blame and must be changed? Or maybe it's just a few loud, bad actors that are getting amplified by the algos. What are your thoughts?
Yeah, thank you, Martin. I think I think that's a fundamental question. We want to get to the root causes to try and understand how to solve them, right? But I think there's a couple of things that I'd like to separate here. The first one is that we are blaming social media for a lot of things. And the second one is that because we're blaming social media for a lot of things, the root causes may differ across the different dimensions that we're blaming them for, right? So let me give you sort of a range of things we're blaming social media for. We're blaming them for inciting violence. We're blaming them for creating addiction. We're blaming them for increasing depression and mental health problems. And we're blaming them for raising political polarization. Okay, these are only a few of the things that we're blaming them for. Then we're also blaming them for market power, for abusing their market power, for which we have a whole set of different tools that belong to antitrust to sort of put checks on them. So let's just focus on these social issues. When it comes to inciting violence and hate speech, for example, I think it's pretty clear that there's a couple of root causes. One is actually the inability of these algorithms to understand all kinds of languages. And even within a language, how that's used changes over time. Okay, so even if we think that algorithms can do a lot of things, they can't do certain things. And in those contexts, actually, is that when you don't have AI, you have to rely on humans to label content, okay? And that's very time consuming and not as scalable as all the things that Marco was describing before, right? And the other important thing is that it's very hard to ramp up human-based content moderation really quickly. So for example, immediately following a military invasion, just to give an example, right? And in addition to that, social media platforms have perhaps not invested in hiring those human content moderators as much. And perhaps because they did that, because they aren't held accountable for the content that's generated by third parties using their platforms, right? And so we have a lot of things that are happening all at the same time that together create the perfect storms for the incitation of violence and hate speech to actually proliferate on these platforms. When it comes to other dimensions of harm, think about depression or mental health problems. I think we got some visibility into potential root causes. So think about the information that we got from the Facebook files, right? The Facebook leak from Frances Haugen, who shared some of the internal documents that she had access to with the Wall Street Journal. And then the Wall Street Journal published a series of articles describing these harmful societal harm that Facebook was creating. But that, and what's important is that Facebook was aware of them, of these societal harms, but kept them under wraps, right? And I think the main issues here come, and they don't belong to Facebook, they belong to sort of social media more generally. They come from a couple of root causes. The first one is that when you use algorithms, you have to tell them, you as the human have to tell them what to optimize over. You have to give them the profit function. You have to give them the metrics that they have to optimize over, right? And so if engagement, the length, the duration of how long I stay on Facebook is a metric that we give, right, the algorithms to optimize over, then the algorithm is going to show content that keeps us on the platform, right? And so, for example, it's going to show us incendiary comments or extreme news, or even, think about pictures of unreachable beauty standards, because those are the pictures that we keep on focusing on, and we keep, blaming ourselves for not reaching, right? So the first problem is this metric definition. What are the metrics that we identify as important for the algorithms to maximize over. The second problem is a problem of short-termism, I think. So algorithms and also experiments in these companies, A/B tests, are by definition optimizing over things that can change very quickly, right? So for example, my propensity to stay longer on a social media platform today is a function of the content that was shown to me today, okay, and not of the past. But there's a long-term perspective here that is missed. The fact that, for example, if you keep showing me incendiary comments and incendiary content, you may end up with a very few users completely addicted to these social media platforms, but actually many more users are eventually going to drop out, and you don't measure that because you are short-term focused on the short-term metrics. And so even if the engagement metrics are correct, I'm not claiming that, but let's assume that for a second, then maybe we're measuring that metric over too short a time frame, right? Like a day or a session. And if we were to extend that period a little bit longer, then we would be able to have algorithms that actually learn to put weight on a different set of actions and behaviors.
So Chiara, you would say that so you're not proposing regulation that tells these digital platforms what their metrics should be necessarily, but rather require that they have a longer time horizon.
Yeah, so I wish we could tell them what the metrics should be, right? But it's very, I think, I'm not an expert in the financial sector, so correct me if I'm wrong, but like, I think it's pretty easy, like in stress tests of banks, for example, you know what the metric of interest is. Do you have enough liquidity, right? In case of excesses. Here, what are the metrics of interest? Like, how do you measure the incitation of violence? How do you measure the creation of addiction? How, do you measure sort of depression? And so there's a multiplicity of variables that we all have to sort of take into account all at the same time. And so rather than codifying this, I think my hope would be that there would be more transparency, right? Like that there would be more transparency in showing both, what companies studies that's negative about their business, think about the Facebook files, but also more transparency in giving access to researchers and academics and other nonprofit organizations to study these data. So for example, the Census Bureau allows academics to sort of access pretty sensitive data in a very secure way. We could design something like that so that we can get access to study these sort of questions. And I should just last thing, I think in reaction to the Facebook files, the US senators actually proposed something fascinating, which was that these companies should give access. It's just, a proposal of a law at this point, but that these companies should let academics have access to their data for research questions that have been approved by the National Science Foundation. Let's bring that to actually light. I think that would be extremely important because we have a lot of hypotheses, but I'm an empiricist. I want to test them.
So Chiara, I love that proposal. It does pick up on an important piece of the financial regulation, which was a degree of transparency to an extraordinary degree of transparency to the regulators, for starters, right? So I remember there was much unhappiness in the land when the regulators proposed that hundreds of thousands of data points be supplied to the regulator every business day as measurements of liquidity. And in terms of making lemonade out of lemons, it turns out that actually collecting and cleaning and curating that data for the regulator and providing it in a reliable way, well, we thought, is there anything that we can do with this data? And we used it to train up some machine learning models, and those models made a very measurable difference in the robustness of our predictions of how much liquidity we would need at a future date, right?
That's
there were
fascinating. I love it.
non-linear patterns in the data that made us better. And then I think part two of where I would go with your proposal, once you had this transparency to regulators, to scientists, to others, is that, well, then you need behavior modification. And behavior modification for banks came in the form of these activities require you to hold a lot of capital, and these other activities require you to hold less. And again, there's a lot of grumbling, and why should this activity require twice as much capital as that other activity when they amount to almost the same thing? There's plenty of problems like that, but it doesn't have to be right in some utopian or academic or platonic sense. It just has to make things better directionally.
Yeah,
so that's
absolutely fascinating example.
Some of your ideas, but now let's generalize and turn to you, Marco Di Maggio. We've spoken, and I think we've been talking about social media. We haven't necessarily said that specifically a lot, but I would really like us to generalize way beyond social media to big tech, DeFi, crypto, digital assets, anything digital. And I'm sure you've had occasion to think about the regulation of digital assets. I'll just start by saying that in my firm, Sixth Street, we've actually put a lot of time and energy into studying the digital assets ecosystem. And the house view is that right now, there are some critical components of that ecosystem, such as stablecoins, that have no regulation, and so much depends on them. And yet it's like pulling teeth to understand exactly what are the assets backing these stablecoins, and more important, what's the mechanism? Who determines what are the appropriate assets? And when you say something is backed, what does that even mean? And back to Chiara's point about transparency, you almost need transparency on an intraday basis to see exactly how many stable coins are issued and what are the assets. And I would say, well, we've got a framework for that. It's called narrow banking, and a stable coin is a bank that has to have one-for-one assets reserves as opposed to a fractional reserve regime. And that, much like with the commercial aviation sector, it used to be getting onto a plane, a random plane. It was a death trap. And it really required regulation saying you're going to overhaul the plane this many times after this many miles, and this is how you're going to service the parts. And and even still, terrible things happen, but the frequency and the arrival rate and severity is the severity is still high, but the arrival rate's much lower. And so the regulation actually opened up commercial aviation. And I would say the same thing here, as opposed to saying that regulation is going to dampen the American lead in innovation. I would say that regulation's necessary to really unleash this, what could be the most powerful thing ever, which is the digitization, the dematerialization of almost everything. So that's my view. How are you thinking about regulation?
So I agree quite a bit, and in some sense, I have seen so many institutional investors that are still on the sidelines because of this, right? They're sort of waiting for some uncertainty to dissipate in this market to then come in. But if you think about it, there are a few low-hanging fruits, and I think the stablecoin is one of those. But if you take a sort of a wider view, the principles to be applied in the crypto space are sort of the same that we would apply in financial markets. And I will focus on three. And one thing to remember is that in each one of these principles, the application or the execution of the way in which regulation should be applied is likely to be different, but sort of the underlying objective is similar. So one, I think that the first one that comes to mind is consumer/investor protection. The crypto space is growing so fast, and so widely adopted, but still it's full of scammers/fraudsters. And so you are likely to need an agency, maybe a new one, to look out for the end investors. What does that mean? What is required at the end of the day is that to make the protocols, because now we talk mostly about protocols rather than companies, accountable. And this also means that as more and more this becomes a sophisticated asset class, we should make sure that also the investors are fully aware and are fully educated before they come in. But in some of the research that I've looked at the data, you see investors managing portfolios of crypto, and then you look at the remaining of their portfolio, and they have no stocks, no bonds, no retirement accounts. So that feels like against any type of finance 101 models, right? And so how much of that is really just the wrong preferences, so much of that is education about the underlying risk that some of the crypto space is nowadays sort of bringing. The second principle is leveling the playing field, right? Most of the financial market is about making sure that the retail investors are not taken advantage of by institutions, by dealers, by sort of bad apples in the market. If you think about the crypto space, this is exponentially more important. There are things that for those who are not crypto nerds like me sounds incredible that are still possible. Think about what's called the miner extractable value, meaning you as a miner get additional value by front running the users that have submitted the transactions on the Ethereum blockchain. If you think about it, that has been banned by financial markets for quite some time. But in crypto, it's part of the compensation for the miners. Or if you think about insider trading, most of the, we are unhappy about Elon Musk tweeting about taking Tesla private, and rightly so. But in crypto, there are a bunch of influencers / people that are, extremely biased that go to the market and try to influence the price of the underlying tokens. And that's also something that obviously is not allowed in the financial markets and should be allowed in the crypto space. And then the last piece is risk, right? And specifically systemic risk. And that I think is very much connected to two of the last points that I've heard. When you were talking about transparency, if you think about it, the blockchain allows you for a lot of visibility into all the transactions, as well as the linkages across different type of protocols and where the underlying risk really reside. And so I think that's something that the regulator could potentially take advantage of, that currently it's done in a very sporadic way. The other thing that is underlying most of the potential systemic risk in this space is the use of stablecoins, right? And it's one that also, in my opinion, is very much a low-hanging fruit. Meaning that, for those who are not in the crypto space, stablecoin is simply a digital asset which is pegged to a currency, mostly USD dollar. The way in which they keep the token stable is by having reserves or by having an algorithmic component. Let's focus on the reserves. Reserve basically means they go and invest these assets that should be invested either in cash or securities similar to cash. If you think about it from 10,000 feet, that sounds like a money market fund. And because a money market fund has a stable NAV, sure, there is no FDIC insured deposits, but the end investors have the reasonable expectation of withdrawing $1 for $1 in any possible time. And we have regulated money market fund by making sure that they invest only in securities that are safe and liquid. And still, they broke the back during the crisis, but we sort of intervened after the crisis to regulate even sort of more strongly and putting more stringent requirements in terms of liquidity. If you think about stable coins, that's very similar. And it's true, sort of, I don't know if you were talking about this specific example, but it's very difficult to learn about what are the underlying assets for Tether, for instance. And when you do, you get scared because you see that either then cash and cash equivalents is like 3% of the overall reserves. And most of the rest is actually commercial paper. And you don't know which companies, you don't know the rating of the underlying companies. And so you start to sort of feel the pressure of, is this really stable or not? And how much of this is sustained by just the belief that this is gonna be stable. So I think that's a big issue. I want to put one more on the table, and I could talk about this for a while. But if you think about from the regulator's point of view, what worries me the most is a little bit of inertia and lack of imagination. Why inertia? Because it's true that stablecoin is very much a parallel to traditional financial services, but it's also true that once you put into on the table the DAO, so the centralized autonomous organization, there are then nuances that cannot just be an application of the framework we currently use. And so I think that, for instance, even the idea of regulating tokens and trying to make sure that these are securities or not securities, I think it doesn't really make sense. Right? What are we trying to achieve? Are we trying to achieve to label them as securities? If that's the goal, then you have the incentives and you know the response. The response is all of these protocols are trying to make sure that are putting forth a front end which is decentralized. There is no management, and make sure that this cannot be passed as security. But that should not be the objective. Right? The objective should be, I want the securities because I want to make sure that the investors have the disclosures. And so I could just enforce the disclosures directly. Right? And so I think that's the inertia point, right? The other one is the lack of imagination, because we sort of don't know where this is going. And having just the same framework that we are using for traditional financial services and applying it might miss the big picture here. And what this creates at the end of the day is huge uncertainty, right? What I don't like in all of these type of conversations between the regulator and some of the participants in the crypto space is that these are somewhat decoupled. And while this should be something that, there should be cooperation in coming up with a new framework, a new way of regulating these asset class, which honestly, even the regulator doesn't really know much about. So it would be nice to sort of having some expertise coming from the industry and trying to understand where this is going and how we should see the risks that are currently arising in the market. So I think that's the big idea for the regulator.
So Marco, I'm gonna just to have a little bit of back and forth here. So I hear you on, you said the possibility of a new regulator for digital assets, though I would say not everybody shares this view, but I'm not the only person who has this view. I am not sure that another regulator beyond the FDIC, the CFPB, the Fed, the SEC, the CFTC, and I've left out so many, DFS in New York. I don't know that a lot of people would embrace the creation of another regulator, but you do bring up a very interesting point, which is if you look at the Securities Acts of 33 and 34, the definition of a security is deliciously circular. It's whatever the SEC says through its processes is a security, and there are some constraints on that, but it's pretty general, right? And so that's a fascinating thought. That
let me push back on that. I think the issue is not the number of regulators; it's actually the boundaries. Right? The issue is making sure that we know that there is one that is actually looking at this market and is the responsible one. In some sense, many have seen the executive order of the Biden administration about the crypto space as a good news, because as sort of acknowledged that the SEC was not the only regulator in charge of this space, and this was seen as a good news for this space. I would have seen even a better sort of scenario where we actually have some clarity about who is taking charge here, and they provide, and is sort of in charge for providing clarity there. Because the uncertainty, I think, creates very strong and very weird dynamics, right? If you think about the stablecoin example, Facebook Libra/Diem failed, but they failed because they asked for permission. Tether and USDC did not ask for permission, and they are live, and they are managing billions of dollars. Right? And so you have very wrong incentives once you have this type of dynamics with the regulator.
Yes. Just a slightly different perspective on that. It was a beautiful day in Paris, and I happened to be speaking with the editor of Le Figaro, and it was the day that Facebook announced Libra. And the editor asked me what I thought about Libra, and I said, "Ça ne marchera jamais." And she said, it will never work. And she said, would you like to hedge or caveat that? And I said, no, I really want you to write it down exactly like that. So that I can later go back and say that I did predict the future. But that one, I'm saying take a slightly different angle from you on that one. That one looked to the various sovereigns, the multiple branches of government, both parties and the regulators, like a land grab for the right to issue legal tender and to enforce the payment of debt and taxes with that legal tender, and to use the sovereign's monopoly on the use of force within its boundaries, right? And I think it was pretty easy to predict that was a war that Facebook was not going to win. So there might have been some combination of asking for permission, but just with the ambition of that strategy and its direct conflict with the sovereign's right to issue tender. I don't know. What do you think about that?
Yeah, so I have, I have a case on Facebook Libra that I call the privatization of money. So I totally agree with that. It's just I feel like there is this, and that's not the only example, right? There is the other example of Coinbase offering a borrowing and lending product. Right? And then they shut it down because they were sort of talking with the SEC, and they understood the SEC was not very happy about launching that product. Well, but there is Compound, and there are many other protocols who have not asked for permission, and you can currently borrow and lend in the market. And so there is this very strange, right, inequality in the sense that who wants to be under the umbrella and being compliant doesn't find a regulator that helps them out, but defines sort of a barrier, while but these sort of make sure that there are a lot of new actors, potentially more dangerous for the end investors, who just launch their protocols, attract the billions, and then who knows what happens.
So, Annabelle, I'm about to turn back to you, but before I do that, Marco, Maggio, just one thought on, yes, it is important to have clarification of the boundaries or the scope of the different regulators. This may be getting too far into the weeds, but some of those boundary problems are super hard. So in the Dodd-Frank regulation, it was pretty clear that the SEC regulated securities and the CFTC regulated derivatives. Well, what if the derivative is a swap on an index of securities, right? And these hybrid beasts are just an inevitable part of the system, and that one caused did a lot of people's heads in to figure out exactly how to comport the regulation at that particular kind of boundary. Maybe it's workable, but it's really hard. Annabelle, there's been a huge amount of discussion about using the tools of antitrust regulation, or maybe this seems terrifyingly dangerous to me, modifying what's left of the Communications Decency Act to adjust the behavior of platforms. What are your thoughts on the tools that we should use and the efficacy specifically of antitrust and CDA amendment? You're on mute still, Annabelle, sorry.
So antitrust has an objective, and it's to ensure contestability of markets and competitiveness within markets, and the ability of newcomers to come in and compete with existing firms. So to make sure that there is no prolongation of dominance by artificially raising barrier to entry or systematic anti-competitive behavior by incumbents against new entrants and other firms. Now, as Chiara mentioned earlier, when she said we accuse, it was the case of social media platforms, but basically big tech now, there is a big backlash against big tech about a variety of forms of abuse. And anti-competitive behavior is an important subset of this portfolio of practices that have been judged by many as abusive. So first of all, I think it's important to realize that antitrust can only do a certain amount of things. Now, what antitrust can achieve in the United States is different from what it can achieve for example, in Europe. antitrust in the United States has been known to, in some conditions, to break up companies. And the breaking up of AT&T and the creation of the baby bells has been done using antitrust in America. There is no equivalent in Europe of application of antitrust to break up different companies. So at least the European thinking over how to regulate big tech platforms has taken a slightly different direction than just updating antitrust. And let's remember that for over 10 years, the European Commission has launched not one, not two, but 3 antitrust lawsuits against Google, with fines that were considered very large in terms of absolute numbers. But many observers, after the fact, thought that behind all this fanfare of antitrust, the results were rather disappointing if you were to measure them by new entrants in the markets that Google was in. That's what motivated the European Union to think about what they called ex ante regulation as opposed to ex post. By ex post, what is meant is let's use the antitrust rules and let's launch antitrust lawsuits after harm has been identified. But the very long delays, we're talking years, and the lack of merit of the remedies has shifted the thinking towards trying to come up with what they call ex ante regulation. And there are 2 different acts there: the Digital Markets Act, which is more akin to ex ante rules to ensure competition and contestability of digital markets. And that's where we're going to have a list of do's and don'ts and some rules about, for example, imposing interoperability on a very small subset of platforms. And here the European Commission has designated a new category of platforms, which they call gatekeepers. And by gatekeepers, they mean companies that can act as a bottleneck or that can control the access of a very large number of business users to particular markets. There's also some quantitative criteria, such as market cap at least superior to 65 billion euros and over 45 million users, to make sure that too much regulatory compliance cost would not affect smaller platforms. So that's one set of rules, the DMA, the Digital Markets Act. The Digital Services Act looks more at illegal content and harmful content. And here it's about identifying new duties of monitoring and reporting of platforms. And again, there is a subset of rules that will be applicable to only the largest platforms, to try to make them more liable as to the content. It's not a regulation that says they should monitor all the content all the time, but that says that if they are being told or if they are being notified that there is harmful or illegal content, that they have to act on it. So competition is only part of the story. There's also the problems having to do with the content, but more broadly, some of these issues have to do with consumer risks. We heard from colleagues about consumer risk before, and societal risk. So there is a lack of accountability of some of these big companies. And let's not forget that they have become orchestrators of vast ecosystems, which cuts across various sectors, and where these companies, up until very recently, were able to make up the rules, change the rules, implement the rules, deplatform whoever they want. And so I think the spirit of those regulation is to add a policing into those digital arenas, not only about content that may be harmful, but also having to do with privacy risk and this question of lack of accountability. Then there is a whole other area which we haven't even mentioned here, and which the existing regulation in Europe doesn't even touch, but I think there will be forthcoming regulation, and that has to do with labor. That has to do with the categorization of gig economy workers. That has to do with trying to protect social rights of workers and to avoid a systematic use of work in a way that says everyone that is a platform worker has to be considered an independent subcontractor, to the effect that the social costs of those activities basically are pushed back to the worker, to avoid a situation where, if you're, say, an Uber driver or a delivery rider, if you're sick, well, that's on you. If you have an accident while working, that's on you, right? So I think there is a whole, and I'm trying to indicate the future here, there's going to be, I think, new regulation on this area as well. So you see, it goes beyond the antitrust.
And Annabelle, would you recommend that approach to the US?
Well, I think that there's already going on some movement of the Federal Trade Commission, for example. There's already actually from both sides a political momentum behind trying to regulate big tech platforms, which was not at all the case under Obama, and which became part of the topic of conversation under Trump, and the nomination by Biden of Lina Khan, for example, Tim Wu, Mr. Cantor, which were vocal critics of big tech platforms' power, seems to indicate a direction of travel. But even if regulatory action doesn't follow through in the United States, I wonder if, in a way that is similar to GDPR, I wonder if new regulation happening in a big region like Europe is going to incentivize the global, multinational platforms to try to harmonize at least some of their practices, if only for efficiency and operations purposes, so that you don't rule or govern the platform in a certain way in Europe and you govern it differently in South America and in North America. So I think there may be a contagion effect of rules in Europe that may affect the platform's behavior, even if it doesn't go directly through some kind of harmonization of regulatory agencies across continents, which somehow seems to be a very elusive objective.
So thank you, Annabelle. So let's open it up. We have a number of questions from those who are listening to us, and all of the panelists can see the questions. So I'll just go through a few of them, and really it's anyone who would like to answer. But if no one wishes to answer, I might call on somebody. And if you really don't want to answer, you can kick it back to me and see if I can answer it. I'm not sure I can. How can we move to a more democratic model of data access, distribution, collection? And I'm going to take that to mean, as opposed to having a platform centralize that data, whatever the data is, content. And what's the flip side of the democratization of data? Anyone like to take that one?
Maybe I can kick that off a little bit. Part of the challenge here is fundamentally math, and so it's a little bit like your discussion earlier, Marty, when you were talking about, well, that's kind of impossible, and we know that mathematically, right? So one of the issues that we do understand is that both networks and data are powerful, or in a good way, powerful, valuable, because they can be aggregated. And if you stop aggregating, then they become less powerful. There was all kinds of interesting math around networks. For example, there's a guy, Barabashi, at Northeastern, that had an incredibly interesting sort of theorem in the late 90s that basically says when you have networks under very general conditions, those networks develop hubs. And it's a mathematical fact of networks. That's why we get stuck in Dallas when there are rainstorms and thunder showers, right? Because that's one of the old American Airlines hubs. And it's just that, it's a law of preferential attachment, which is when you're attached to many things, more people want to attach to you because it's efficient for them to get outside to the center. And so if democratization of data means having flat sort of a flat society without any aggregation of either data or of networks, we're basically missing out on the whole point of why these things are valuable. It's also, you know, with a lot of this, it's really tricky to think about this. Like, in going back to some of the arguments that Annabelle was making a minute ago, because I've worked on a lot of these cases. I've worked on Android on behalf of the European Commission, actually. And it was interesting because, you know, back then, like, anything that you define, as Annabelle was saying, you know, define the other day, it was like, what's the point of all this work if all you're going to do is find this guy's $5 billion or 5 billion euros? It doesn't make any difference. But crafting a proper remedy is incredibly challenging. And if that remedy is static, that says, if you are bigger than that, you shall do this, is really, really not going to solve the core problem. As we talked about, sort of the core problem being one that characterizes every organization out there. It's not clear that it scales. Like, would you rather have, you know, Parler handling social media than Facebook? You know, here is a smaller, more targeted thing. And by the way, it's not even clear that you can optimize things around principles. Like, is privacy a good thing? Well, you know, Shally would say, of course, privacy is a good thing. But, you know, if somebody is out there starting a revolution, you know, you might want to know about it, you know, and so keeping that discussion private has its challenges, and openness also has advantages. And by the way, you can show mathematically that the more you optimize around privacy, the more you're going to have problems around bias. Differential privacy creates bias issues, just simply because you can't even see it anymore. So if you can't see it, how do you know that you're doing it? And so these things are over-constrained problems with lots of trade-off. And again, if you go back to your experience around financial regulation, which I think is such a powerful analogy, I think that the kind of regulation that we deal with here that we need to think through is way more complex. Like you talked about, you know, sharing trading data every day. It's like in Christchurch, the Christchurch shooting, you know, we're talking about minutes, and the video was out there, it wasn't shut off, and it turned into a disaster with millions and millions of downloads, despite all kinds of activity trying to shut this thing down. And so these are difficult problems. And so I think we really need some innovation in how we think about regulating something like this. And I'm going to say just sort of one last thing on this, and even on the data side. One of the things that if I think about sort of the most successful regulatory effort, I think, of all times, my favorite, my recommendation has to do with good old Microsoft Windows back in the day. But I would not give credit to our friends at the Department of Justice or in Europe. And I've worked on some of these things as well. But I would give credit to the open source community, right? So the open source community organized around providing a fantastic alternative to Windows, which has become the dominant, in a good way, right, provider of operating systems. And it's really fantastic. And the open source community is an incredibly structured, self-policing organization. I think it's a really interesting model for thinking about how we build something that scales, that's reactive. And so in some ways, this, we might want to think of regulation as less as something that happens behind closed doors in offices somewhere in Brussels or in DC, and more in terms of sort of what are the kinds of incentives and what are the kinds of opportunities or technologies or boundaries or that we could provide to communities to go out there and help with this as well, right? I'm not saying they shouldn't be doing everything, but we need some way that the regulation can scale and be responsive on the rate at which these problems arise. And sometimes the time scales can be seconds, microseconds even, right?
Marco, I have to ask, what do you think of distributed autonomous organizations, or DAOs, as an alternate form of organization, since you mentioned open source?
Well, yeah, I know. I mean, it's a fantastic ideas, and I love it to the extent that it's effective. But then you go back to Barbashi, and to some extent, the hubs have value. And that's why, you know, at the end of the day, you know, you could try to distribute everything, but if the value comes from aggregation, which is true for many of these models, you're sort of bypassing, like, you know, you want to break down Facebook, you can break down every major social media platform that's more than $50 billion of value. Are you going to solve the problem? Or are you going to, you know, sort of, if you break it down into a number of individually active you know, micro organizations, which of these problems are you going to solve, and which other problems are you going to create by that, even if it was possible? So again, I'm not a huge fan on that idea for
my problem with numbers like 50 billion or 65 billion or whatever the number is, it's the magic number pulled out of a hat, right? There's all risk accumulates at that boundary. Always the organizations will twist themselves to avoid going over that by $1.
And I'm more worried about the little ones in many ways. Again, you know, just think, you know, Facebook is bad enough. I don't think Parler is going to be any better, you know, or whoever the next, you know, super crazy you know, thing that comes up when Parler gets shut down. I mean,
well, that's my problem with antitrust. I think it just makes you know, 100 little versions of the problem that then all get bigger.
Yeah. But Annabelle said it, because antitrust is one of the issues, but it's not the only issue. And that's a really important thing, because like there are many things where having smaller scale organizations is going to make the problem worse. And that's a really important thing to think about as we think through sort of where we might go with this.
We have time for a couple more questions. This one might be for you, Chiara, but anyone could take a crack at it. Is short-term optimization a very real problem for self-regulation of AIs?
Yes. So maybe I'm going to answer by not answering the question, in the sense that, yes, we've highlighted a ton of problems today, right? But I kind of wanted to step back and place this on a broader perspective. I think a lot of new technologies, a lot of new innovations, a lot of new business models go through these sort of trajectories where there's huge optimism early on. I think blockchain and crypto are sort of in that stage. And then that huge optimism is followed by huge pessimism about all the evils that these new innovations create. And I think with platforms, we are in that phase of evil. Yes, you know, the short-termism of algorithms is the cause of many of our problems. But I think we should eventually get to an equilibrium point where we recognize the value of these platforms and these algorithms, which are hugely effective at sort of providing us what we want when we want it, and really be careful about the challenges that they may arise. And so, you know, it's not by chance that Russia has decided to censor and ban Facebook, because of the huge potential that Facebook has in transferring real, true information to the Russians. So I think we shouldn't forget all of the values that some of these companies have created with attention. We shouldn't be sort of, you know, complacent, but we should pay attention to these negatives that we're facing right now.
Thank you, Chiara. We've got maybe time for two more. Here's one on the financial services industry. One of our audience members observes that the financial services industry continues to ignore its greatest challenge, which is to replace deeply entrenched legacy sell-side books and record systems. Until this problem is addressed, operational inefficiencies and risks will grow. And what would you do about it? I'll just say, before adding that one to you, Marco Di Maggio, that I alluded politely to this when I said that there were problems in the pandemic, but they weren't bank solvency and they weren't bank liquidity, but were in fact operational problems in the processing of repo transactions, the way wholesale financial firms finance themselves, right? If you're a person, you might put $1,000 in a bank account. If you're a bank, where are you going to put $1 billion? And the answer is you put it in the repo market. And that came very close to breaking down. So what are your thoughts on that?
Yeah, no, I agree that these are sort of huge issues, and those have not been addressed post-crisis, are still sort of up in the air. And I think that this has been one of the motivations why we've seen fintech arising in many of the dimensions and many of the functions that the banks perform nowadays, because sort of they are more nimble on some of these operational issues. And so we have seen a proliferation of different actors that are somewhat in the gray area in terms of to what extent they're regulated. And they might create further sort of issues than the current incumbents. And so it would be particularly important to force the incumbent to innovate rather than allowing them to further entrench within their systems. I'll give you one simple example. If you think about the way in which credit underwriting happens, right? Nowadays, most banks rely on the FICO score. And the reason why they rely on the FICO score is because the regulator in the form of Fannie and Freddie mainly rely on FICO when they decide whether to purchase mortgages or not. If you're talking about mortgages, similarly, investors on the securitization side, they are relying on that to assess the risk. Well, more and more has come up in the last few years, showing that FICO is a particularly terrible measure of riskiness, especially for minorities and for what might be invisible to the banking sector. And so if you think about the banks continuing to just look at one single measure, let me put just extreme, put this at extreme, what the result is that either you are excluding rationing people out of the credit markets, or you are allowing entrants to use different type of data to do the underwriting. The way in which you allow these other actors to come in and use different type of data might actually pose new challenges, right? Because then the new additional data, the alternative data they may use, might potentially be biasing the underwriting as well. And the way in which you are monitoring those is in a very different way than the way in which you are monitoring the legacy players. Meaning the banks might be highly regulated by for instance, the Fed, while these new entrants are mainly regulated by state regulators plus the CFPB. And so it's very much ex-post regulation once something has happened or they found out something has happened rather than ex-ante. And so I think that's one of the reason why sort of allowing the banks to innovate on the operational side might actually benefit the markets overall.
So let's do one last fun thing here, and then I'm going to turn it to David to wrap us up. This is completely unexpected by my fellow panelists. So how can we apply AI to regulation? I would love for each of you to say something in 30 seconds or less on that question from the audience. So I'll start with you, Annabelle.
Yes, so AI can be applied to a kind of regulation, and I would say it can be applied to self-regulation. I think that self-regulation will have to play a role alongside top-down regulation. We have actually a paper about it with Mike Cusumano and David Yaffe, and we look at how self-regulation was effective in a variety of sectors, advertising, broadcasting, airline reservation systems. And the moment that, the favorable circumstances for self-regulation to be effective is precisely the moment that we are in now, which is when the threat of top-down regulation becomes credible enough. Yes. And that there are some technologies or some ways to make self-regulation not too costly. And I think we are exactly in that sweet spot. So far, AI has made some kind of regulation or content moderation possible, better at identifying terrorists than identifying cyberbullying. But I think there is a lot of potential for how AI can be used, in particular for self-regulation.
I agree. I love that. Marco Iansiti, what are your thoughts on how AI could be applied to regulation?
Well, that's the only way you're going to know anything is wrong, fundamentally, right? So I think that we need to have the tools to figure out when something is off, especially with regards to issues around, say, for example, disinformation, right? How do you even know you got a problem without AI? How can you respond fast enough? And this is where, again, from a regulatory perspective, we need to understand how a system like that can be deployed, who owns it. Is it okay to just rely on the companies themselves to do it on their own side? And how do you monitor that it's properly done? So I think that the capabilities there will have to be distributed, embraced by regulators, ideally embraced by communities, and we're going to have to think sort of creatively about who's going to have the tools to use the AI to figure out what's actually going on and ideally responding fast enough to make a difference.
All big challenges. Marco Di Maggio, your thoughts?
I will be mindful of the time because I want to give Chiara time as well. Just quickly, I want to launch a crazy idea. Blockchain allows you to get data as much as you want. Why not using AI to actually look at these transactions, for instance, or any type of transaction on the chain, not just payments, to predict not only illicit activity but also where the risk is growing in the system. Can we do that? Can we do that ex ante before we actually, the bomb explodes in our hands?
Yes, I love that idea. Chiara, your thoughts?
Yes. Echo what all the other panelists and my colleagues have said. It's a prediction tool. And so you're going to better able at identifying who the regulator should go after. And so I have an example in which, for example, you can look at online reviews to identify which services are unlikely to comply with regulation, and you can go after them.
Love that. David, over to you.
What a wonderful journey. Thank you, Marty. Thank you, panelists. We started with the Economist piece, asking what we can learn from financial regulation. And I think using Annabelle's phrase, what can we do about these orchestrators of these very fast systems that urgent complexity is, am I still here? Am I back?
You froze for a second. Go ahead.
I'm back. Okay, there's this kind of emergent complexity that I think about, which is you give your algorithm some objective, but you don't know what effect it's going to have on the system. And for me, that really situates the challenges of regulation here. I think I heard a number of our panelists acknowledge the need for regulation, but I also heard people expressing caution and about it's going to be complex. Marty, I really liked your analogy to the railroad systems. Made me think, well, obviously, what are the intersections for platforms? What is the digital intersection? Reflecting on what you said, Chiara, what can we measure? Where do we want to get the transparency, and what effect might that have? I think, Annabelle, you spoke very nicely to it not just being about antitrust. I know Marco has asked for more imagination in the crypto space. Makes sense to me. I think we should be able to do different things there because there is inherently more transparency. You see the smart contracts, you know what they're doing. And then lastly, I wanted to end on Marco Iansiti's comments, which I think it was quite thought-provoking and actually resonated with me, this view that probably this is going to be harder than regulating finance. The speed, the complexity. I think that maybe a simple way to say it is it's not just going to come down to capital or finding what is the right analogy to capital. So I love the conversation. Thank you to all of you. Those of you out there in the audience, please keep paying attention to the Harvard Data Science Initiative activities. We're here for the data science community at Harvard and outside of Harvard. But with that, we're out. And again, thank you to all of our panelists and to Marty Chavez.
Thank you all. Have a good day.